Okay, so I'm about to sneeze. I'm sorry. When we look at inventory, we know that if we're a retailer, we're buying it from someone. We're going to turn around and sell it to someone. Chapter 5, we learned that stuff's not free. We're going to have a sale, but then we're also going to have this cost of goods sold that happens. The question is, at what cost? If I'm Target selling TVs all year long, likely the price has gone up as I buy new batches of TVs. So when it's time to sell the TVs, which cost are we going to apply to COGS? In other words, what we bought them for way last January, mid-year, end of year, December. If the price has been going up, the question mark, the big stop and say, all right, we've got all these different costs going on because inflation and rising prices and you name it. The cost has been going up all year, so we're going to stop and say, well, which costs are we going to apply to COGS? That's the whole theme and question that this chapter asks. The 4 cost flow assumptions, so the 4 ways to tackle which cost we're going to apply to COGS, are the 4 that are listed there. I want to quickly talk about specific identification, but know that it's rarely used. And then I'm going to focus today on FIFO, or applying the cost of what we first did, hence the name first in, first out. We're going to apply those costs that first came in. So I'm going to zip ahead. Again, specific identification, let's talk about it first. You need to know that it's practiced very rare. Most companies make assumptions about which units were sold. So if I go back to my Target and my TV example, and I even backtrack one more here. Instead of Crivet's TV, I could replace this with Target. If Target's buying TVs, the same 50-inch that they're going to sell for $1,200 no matter what, the big question is, what cost are we going to associate with COGS? Especially as the year went on, the prices were going up by $50. So I'm selling these 50-inch TVs at $1,200 a crack. I have 3 different costs. Which one are we going to use? It matters. It matters. So if this, again, I'm going to use TV, or Target. Target's selling this TV. They're going to physically take the one that they sold in February. I think this was the February TV. And then they're going to sell the one that was on May 22nd. That's the May TV. Does that impact their net income? It does. Because we're selling this guy bought this TV. Remember, I'm selling it for $1,200 minus COGS, which in this case was $700. My gross profit there is $500 versus if I sell the same 50-inch TV to this lady, look at how happy she is. Selling her the May TV, same price, but this one I'm selling for gross profit here is $400, which is the obvious cost we should use, the cheaper one, because then we can make more money. So what I need you to know is don't think about it as the TV. Think about what cost was associated with the TV. The one business that I can think of that probably uses this are car dealerships. If they sell the $90,000 Corvette to someone, do you think they know exactly what they paid or what their cost was? Yeah. Cars are a little bit more exclusive. TVs, a 50-inch TV is a 50-inch TV, and Target probably has 2 or 3 out on the floor. One is a display model and a bunch in the back. Heartland Motor Company probably has one red Corvette, and they know what its cost was. So this is rarely used. This is all that we're going to talk about this, because it's not necessarily practical unless you're a car dealership. So let's get into FIFO. I'm going to talk about FIFO first, and then I think the video will make more sense. I can't stress enough, and maybe I'm putting more pressure on myself than I should to get this right for you guys, but don't think of it as the stuff. Think of it as the cost of the stuff. Because going back to the TV example, it was $700 and $750 and $800. They're selling those TVs for $1,200 a piece. It's just, I'm not grabbing the February TV and handing it to the customer. That would be specific identification, yes. But just know, sweet, what's the C of COGS? Well, we're going to sell these things and say that our cost was $700. But in rising prices, things get messy. FIFO stands for first in, first out. So again, I'm not necessarily selling the first thing that came to me as a store. I'm selling the first cost I paid. Costs of the earliest goods purchased are the ones that you are going to recognize in COGS. Going back to the TV example, 700, 750, 800, I forget the dates, but you know that they went incrementally. If I'm Target and I'm selling these $1,200 50 inches, and I'm using FIFO for my costing, what am I going to say these TVs cost? $700, because I'm not talking about the TV itself that came into me in February. I'm talking about the cost. The first cost is associated with cost of goods sold. What's natural about FIFO is that it often parallels like how stuff physically flows in. Really what we're going to do as we try to calculate this is we're going to work backwards. We're going to look at what we start with, what we add, what's still here, what's gone, and then it's this big process. But I just want you to understand that it has nothing to do with the stuff. It has all to do with what the cost to try to determine cost of goods sold. Must be one of you ringing. Or maybe it's an airplane. Never mind. I don't want to try to complicate things, but let's talk about strawberries a minute. If we were to talk about the stuff, which strawberries do you want to buy? You probably want to buy the newer strawberries, right? Which ones are going to be at the front of the shelf when you go into Willie's, though? The first ones that came in. Okay? I dig in the back for strawberries and softies when I go to Willie's. Okay? So that if this was a lesson on stuff, we all can be like envisioning Jenny Mars digging in the back for the best, newest, freshest softies, right? But this isn't about stuff. This is about the cost of the stuff. Let's go back and see what this video has to say. I'll link this video. It's going to be really glitchy on the recording, but I'll just put the video with the link for today as well. What I'm going to do is I'm going to walk through the comparison of inventory valuation comparing FIFO, and weighted average. So we may come back to this gal. She's actually, this is a Wiley produced film, so it goes directly with our book. I want to hear what she called it again, because it's a really great way of describing this. Inventory valuations. So we have this back room of TVs. What are they valued at? Inventory valuation. We knew that our prices were rising throughout the year, 700, 750, 800. The question is, are we using FIFO, LIFO, or weighted average to put a value on that inventory when the prices were going up? All I want her to do, she's going to compare all three. I want you to really hone in on the FIFO stuff. We talked about this yesterday. Here is where, this is what we talked about yesterday. This was basically the theme of Chapter 5. If I had to change gross purchases to a word, I'd say inventory. Plus to get it to us, minus any returns, and minus discounts that we got. All of that should make sense to you. That was Chapter 5. Chapter 6 is just placing a value on all of this inventory that's sitting here. And the question is, if we're using FIFO, we are going to put a dollar amount that was the first one that came in. Not necessarily the first stuff, but we're going to account for that evaluation of what we paid for the first stuff that came in, or the cost. So as we try to figure out a dollar amount or value, there's 4 options to use. You're not mixing them. It's one of the 4. Which of the 4 is rarely used? Specific identification, unless you're like a car dealership. Okay, so she's starting with FIFO. I've explained this once. She's going to explain it again, and hopefully it starts to click. FIFO stands for what again? First in. Are we talking stuff or dollar amounts? Dollar amounts. So yes, stuff came to us first, but we're talking about what valuation or dollar was that stuff. Going back to my strawberry examples, they're all really expensive right now. They're expensive to buy for consumers, but they're also expensive for the retailer to buy. Is this the first thing that you're buying? What dollar amount is it assigned to it? Bought it for $1. What I like that she's doing here, she says, who cares how many there are? There might be 1,000 things in this box, or it might just be one. So I like her concept that it's who cares about how many we're buying. We're just buying them at $1 a piece. And then typically prices go up. So we see $2 for the next purchase. And then when you purchase more units, that layer of inventory would be $3 a unit. Now what we want to do is the cost flow of those units. You're using FIFO. That means the first one in should be the first one out. This side is inventory. Does it mean we're selling the dollar items? No. Just kind of like my gas tank example yesterday. They go pump gas into those gas tanks below the pumps. It all flows into one big liquid tank. It's not like I'm like, ooh, I want the dollar stuff. In a bricked version here, yes, you see the dollar stuff physically being moved, but it might be the $3 things. It's just that you're assigning the value of the stuff, not the stuff. Why is she making so much net income? Didn't cost her very much. So there's more bang for your buck there. You know, go back to my TV example. I sold the cheap TV. I made $500. Right? Oh, I forget. Yeah, because it was $700. Yes. Like where did I? $1,200 TV that I sold for $700. Well, or then I ran out of those costs, so then I had to go to the next one. So FIFO will result in the highest net income because you sold during times of rising prices, which that tends to be the norm. During times of rising prices, FIFO will result in the largest net income because you're selling the stuff. It's just that the cost is the smallest. Yep. Yes. And you're going to see that play out with numbers here when we actually do it. But yeah, absolutely. Remember, FIFO, first in, first out, is return to the flow of inventory. One of 9 specific units is the physical flow of goods. So you get the flow that we are assigning, the manner that we are assigning value to inventory. So let's go ahead and start all over again. And now let me go ahead. Do you want to do LIFO or should we just wait? Would you want to see her play it out here? Might be helpful, or maybe it will be more confusing. Let's just try. So what do you think LIFO stands for? Last in, first out. So which little block is she going to put on here first? $3. Ooh. So she's still buying it in this order, but which one's she going to drag over here as she sells stuff? The stuff, remember she's selling stuff, but the question is the C. What was the cost? And the cost is now the last stuff that came is the cost that we're going to assign. Magic. What would the benefit be to this? Why would you want to make it look like you didn't make much money? Taxes. Thank you, you're right. Plus, cost of goods sold is a lot higher here. We're selling the expensive stuff. Well, it's not necessarily the stuff, it's valuing the expensive stuff. So what it's doing is it's making you look like you're making less money. Then when it comes time to tell Uncle Sam how much money you made, it appears you didn't make as much. And then Uncle Sam's going to say, well, you don't have much sitting in inventory either. So then it's less of a, what's sitting there still left in inventory is the cheap stuff. Did it help to see both? Maybe. We'll come back to her. Plus her magic under the table tricks are very fancy. I would like to try this with you. Do you have this in your notes? Or does it look like this? Okay. Let's first analyze what we've got going on here. Are we still selling TVs? What are we selling here? We're selling condensers. Houston Electronics Astro condensers. Why don't they give us, like puppies or something? But whatever. So we first have to figure out, I have to grab one hand out at the printer. Hang on. We first have to sit and figure out, well, what do we even have going on here? Well, it looks like on January 1st, we had stuff, 100 units at a dollar amount of $10 a unit, okay? Are we having a time of rising prices? Yes, because then a few months later, we bought 200 and the price went up $1. August 24th, we bought more stuff, price went up another $1. So the reason we're getting, here's our stuff, here's our cost, and then in November we bought more. We need to figure out the stuff that's here and the stuff that's gone. And then so we're kind of working backwards to try to figure out our C of our cost of goods sold. I am going to go to the slide that you have. This is the same thing that I just wrote on a little bit. If we're going with FIFO, we are selling our first costed items. So we're valuing, I don't think I spelled that right, but that's all right. Valuing our sales at our oldest cost prices. Does that make sense? First in, first out. The first in is our oldest stuff. So our newest stuff, or the cost of our newest stuff, is still here. And I assign SH to that. We're trying to figure out the cost of S, what sold, and we're also trying to figure out the cost of shush that's still here. You saw the lady have her little bricks. I'm going to just make circles. And as she sold stuff, she moved it over here. So this really was her shush pile, her still here pile. And then there was the stuff she sold. And in FIFO, you're selling your oldest stuff. The newest stuff, or the stuff that you bought most recently, is shush, or still here. Okay. So out of our beginning inventory and purchases, what's still here? The cheaper stuff or the more expensive stuff? More expensive stuff, because FIFO is the first stuff we're valuing that we're going to sell, and the more expensive stuff is shush, or still here. I want to write this all again, just so you can hear it again in maybe a different way. First in, first out. The oldest or first stuff is what's gone, and we assign the cost of what's gone. The newest, or the last stuff, is SH, or still here. That's how FIFO works. The stuff is stuff. It's just, again, what valuation can we put on the stuff that's gone and the stuff that's still here? The stuff that's in our warehouse was expensive. The stuff that we've sold to our customers was cheap. Are we going to have a higher net income or a lower net income? Higher, because our cost was going to be cheaper. We valued the stuff that left with the customers at a more reduced rate, so it looks like we're making a lot of money. All right, let's take a look at a few more things. We have a total of 1,000 units of stuff. I'm going to change pen colors here. Minus 450. I came up with that number because that is what's shush, or still here. And I want you to put that. Shush, still here. That's why yesterday during the lecture and the book wanted me to talk about that with you. Somebody or some company came in and counted all of our stuff that's shush, or still here. When did they do that? Probably when the business was closed. Why do they do it in the retail setting around after the holidays, first thing in January? Because we as consumers wipe out the stores because we buy a lot. So it's a great time to count when there's not a lot of stuff around. So we have to take our total minus shush to equal what S sold. How much sold? If we started with 1,000 and 450 is still here, how much sold? How much is gone? 550. This is all pertaining right now to stuff, not the valuation of it, not the dollar amount of it. We're just talking stuff right now. You heard the lady say that. We first have to figure out what we started with, what's S or sold, what's SH or still here. So out of the 1,000 things that we bought, 450 are still here, meaning 550 must have sold. So that's step one, figure out the stuff. Now we need to figure out the cost of the stuff S or sold and the cost of the stuff SH still here. So the top portion is stuff. The bottom portion is the dollar amount or the valuation assigned to it. We work backwards. Here's where I get students pretty confused. We have to work backwards. We first have to, step one, we first have to put a value on what's still here. We have to start with what's still here to figure out with what's gone. Then we can go over to the S side of things, what's gone. So I'll put my S over here for S equals sold, or what's gone. SH equals still here, or the ending inventory. You're not going to hear the book talk about shush. That's just more of a Marsism. I like to talk about shush, what's still here, and then what's sold and what's gone. So the reason this is going to feel backwards is because we're first going to look at what is still here. Then we can back into the cost of goods that are gone. November 27th. We're going to take a look at our very last thing. And you might say, wait a minute, this is Mars. We're talking about first. First in, first out. Yeah, that's the stuff that's gone. Step one is actually backwards. We have to figure out what's shush or still here. So on November 27th, we had 400 units at $13 a crack for a total cost of $5,200. So I would take 400 times its cost to equal the cost of the stuff collecting dust on our shelves. Trick question coming at you. What's our next most backwards date? August 24th. How much did we buy on August 24th? 300. Here's my trick question. What's shush? What's still here? 50 of it. Good. I can't stump you guys. The reason we only are going to use 50 of that 300 purchase is because somebody counted and figured out we only had 450 shush are still here collecting dust. You still can take it times it's $12 that you paid for those items to equal $600. I'm gonna, if this part confused you, trust me, I'll get you there. The next line we would just say 450. So the 450 things that are still sitting here, because we're on the valuation side of all of this, they're costing us $5,800 to be collecting dust. You answered this question already, but the more expensive stuff is still here. I'm going to put this one on the back burner. We're going to keep going. We're going to go to the F side of things. Finally, we're going to figure out what's sold, what's gone. First in, first out tells me that the oldest stuff, the first things, hence the name first in, the first values are what are gone. Cost of goods available for sale was already calculated from above. You see an arrow there, but that's where that dollar amount is. Cost of goods available for sale. So the cost of stuff that we had to even sell minus the cost of shush, which we just calculated over here, finally can equal the cost of goods sold. So you go into it backwards. You figure out the cost of the shush, the stuff collecting dust still here, to gather what is cost of goods that are gone. One thing I like to do, and hopefully this doesn't confuse you, but if I go back into, we had 1,000 units available minus the 450 that are still here equals 550 that are sold. Again, this is the stuff. This is the valuation of the stuff. You back into it this way. So if I made a column that said S and I made a column that said SH, there's my SH, 450. Over here, 100 plus 200. How many did I sell? Ah, yes, plus 250. It's a way to double check your numbers. See what I mean? The oldest stuff is gone under FIFO. That's the first thing that's gone. The newest stuff is shush is still here. All of this is going to be flipped when we do LIFO. Because when we do LIFO, we recognize the latest stuff first, hence last in, first values out. And then the newest stuff is shush, still here. So it would all be flipped for LIFO. This slide, do you have this slide? Tell me you have this slide. Very good. This is what I just did. See how right in here, this is kind of the pivotal number because we're using partial of it that's sold. What I like about, I'm talking stuff here, I like this slide because it's the valuation. Um, 250. That's the same thing I just did on the previous slide. It's just putting the valuations there. I really like that slide. The stuff that sold and they put it on a truck, it's left, versus the stuff that's shush or still here collecting dust in the warehouse. I don't want to confuse you, but look what their helpful hint is. When you think about FIFO, the oldest stuff's gone or the first stuff, or you could think of it as lish. The last in is shush, still here. I don't like that one though. I use SH just for what's sold and what's still here. We're not going to add another acronym to the mix, lish. I think it's a good stopping point. If you're confused, I'll crank through it again tomorrow. We could even rewatch The Lady because she's good. Plus she's got the blocks under the table. What I'd rather do before we get into last in, first out, or LIFO, I'd like to rewatch The Lady. I'd like to talk through this again, and then I want to do a problem with you before we even tackle LIFO. Is that okay? It's just we're at a good stopping point. We're a few minutes early, but